Hello guys, good morning, good afternoon, good evening, depending on where you are and where you are watching me from. I'm hereby going to take you through financial reporting and analysis, and specifically a topic called borrowing cost in under International Accounting Standard 23, IAS 23. Welcome and enjoy the lesson. Thank you. First and foremost is want to understand what is the meaning of the word borrowing costs. That is very important. Number two, you want also to know the objective of this particular borrowing cost. Number three, we want to know how to calculate the borrowing cost according to IAS 23. Now, first and foremost, let's first of all know what is the main objective of this particular borrowing cost. The main objective of this particular borrowing cost is to know how to prescribe, to know the prescription of treatment of this particular borrowing cost in our financial statement. So by the end of this particular lesson, you'll be able to know how to prescribe the treatment of the borrowing cost in our financial statement. The first question that comes in our mind is, when you go to any financial institution and ask or request for a loan, immediately you secure that particular loan, automatically the interest is charged. And that chargement of that particular interest on the loan is not supposed to be paid immediately. You are given what they call a holiday period of time. That is payment period. That's holiday period for maybe 2 months or 3 months, depending on the amount of loan that you have borrowed and for what purpose. So the question we are asking ourselves is, this interest that is actually accruing on this borrowing funds, are we supposed to treat as an expense, or we are supposed to add it on the asset that we are constructing just because of the fund? According to IAS 23, it was revised in 2007, 30th of March 2007, and the revision was now made to ensure that all the borrowing costs are supposed to be capitalized. That is to say, all the borrowing costs relating to the construction of a qualifying asset need to be added as a cost of the asset. For example, you have apartment like this, whereby you have incurred a cost of around 20 million. So out of this 20 million, you need also to add any borrowing cost that you have incurred so that you get the correct cost that you have incurred on this particular apartment. So, but before 2007 and prior, what was happening is that accountants were given an option on how to treat this borrowing cost. You are told either treat it as an expense, that is to say, debit the P&L account. That is, treat it as a normal expense or ordinary expense. Then number two, you can decide to say, let me capitalize it or treat it as an asset. But now, after 2007, the IAS was revised, and up to today, we are using capitalization as a method of accounting for treatment. So we are saying that this borrowing cost here, by the end of this particular lesson, you'll be able to prescribe the treatment of borrowing cost in the financial statements. So when I talk about financial statements, I'm purely referring to profit or loss and other comprehensive incomes, and also statement of financial position. So profit and loss and other comprehensive incomes and statement of financial position. Now, on this case, we are also saying that under this IAS 23, we have two main terms that we need to understand. The first term is what we call borrowing cost. What is borrowing cost? According to IAS 23, borrowing cost is interest and other expenses, correct, incurred, correct, by the entity, correct, by the entity in connection with borrowing funds. So here we have now the two terms, that is interest, and also we have other expenses. So other than the interest that is normally incurred on the borrowed funds, we have also other expenses that are incurred in connection or in relation to the borrowing funds. Now, in this case, it means that for us to get the correct borrowing cost, we need to take the interest that is normally charged per year plus other expenses that are incurred purposely for borrowing funds. Correct? Now, on this case, we have also another term that why are you borrowing these funds? What is this fund for? So this fund is actually to do what they call qualifying assets. When you talk about a qualifying asset, we are saying this is an asset that takes substantial period of time to be ready for use or sale. So we want to understand the meaning of that substantial period here. When you talk about substantial period here, we are talking about a period more than 1 year. So any asset that takes a period of more than 1 year for it to be ready for intended purpose or for sale is classified as a qualifying asset. Any asset that you construct and it takes less than 12 months or less than a year, it doesn't qualify to be called qualifying asset, but to be described as any asset under IAS 16, that is property, plant and equipment. So therefore here we are specifically on the borrowing cost that is now leading to a qualifying asset. So a qualifying asset is that asset that takes substantial period of time for it to be ready for use or sale. And the substantial period of time here, we are talking about a significant period. That is to say, more than 1 year for that particular asset to be ready. Correct? Now, on this case now, we can now say what are the examples of borrowing cost. Not all the costs will fall under the borrowing cost as per the definition. We have been told that borrowing cost is the interest and other expenses incurred by the entity in relation to the borrowing funds. So we have also other expenses. That is to say, maybe we have the processing fee of that particular loan. It can also mean maybe the risks that can be incurred for that particular loan, or maybe the facilitation. That is to say, maybe the lawyers being used there to make that contract between you and the financial institution legal. So for that matter, we are saying we have also other costs that we are incurring. So those other costs need to be incorporated when determining the borrowing cost. Therefore, before we go there, let's list down examples of borrowing costs given under IAS 23. There are 5 of them. The first one, and I want you to pay attention to these costs, because you'll be asked in your exam to highlight and explain borrowing cost as per the IAS 23. As per the IAS 23. One is interest on bank overdrafts. Correct? Short term and long term borrowings. Yes, borrowings. So you can borrow either in the form of a bank overdraft or a short-term period of time that is less than 12 months, or you can borrow it for a long period of time. So another example of the costs that fall under borrowing cost is what they call amortization. Amortization of discounts and premiums. So first and foremost, maybe you might be asking what is the meaning of the word amortization. So when you talk about amortization here, we are referring to spreading of discounts or spreading of premiums over a period of time. For example, you have borrowed money for 5 years. That by the end of the 5th year, you will be in a position to repay the entire loan that you borrowed. So in this case, if there is any discount you are given, you need to spread over 5 years. And if there is any premium means additional cost on the borrowings. Additional cost on the borrowing should also be spread over 5 years. Now, in this case, for example, let me make a demonstration on this. For example, you have borrowed a loan for 10,000, and out of this 10,000, you are told that the interest rate is at the rate of what? 10% per annum. So if you say 10% per annum, how much is the interest in this case? The interest here is what? 1,000. So if there is a discount, if this the loan of 1,000 is here, which means by the end of every year, you should be paying how much? 10,000. If there is a discount, for example, let's say a discount of 2%. There is a discount of 2%. What will happen? It will be 2% of this, which will give you how much? 200,000. A discount will reduce the amount of money you are supposed to pay. So in this case, it will be reducing the interest of how much? 1,000. So when you talk about a discount here, you are talking about a discount here. You're talking about amount that will reduce what you are supposed to pay. Correct? On that note, you cannot subtract the entire 200 from here. Why? This 10,000 is for 5 years. And for that matter, we have to demonstrate the meaning of the word amortization, which I've said amortization means spreading of an item over a certain period of time. Therefore, this 200 has to be spread over 5 years. For example, if this is the 5 years. So therefore, you now say you divide this one by 5 and you get your 100 shillings. Is it 100 or sorry, 10 shillings? So this 10 shilling is per year. So if you want now to know how much is the borrowing, how much is the borrowing cost in terms of interest, it will be 1,000 minus 10. So your figure is how much? That is 990. You can see. So you are supposed to pay 990 if it is about discount. If it is about a premium means the cost will be increasing. So for that matter, instead of you paying now the 1,000, you will pay more. If that is the case, it will be 200 as usual. For assuming now that the premium is 2%, 200 as usual, you divide by 5, then you get 10 shillings. Now in this case, because it's a premium, you add. So it will be 10, 10. So you'll be paying 10, 10 by the end of the year. So when you talk about amortization, it's the spreading of that. Now the second type of cost is amortization of auxiliary. So amortization of auxiliary costs. Now, in relation to borrowed funds. Now, when you talk about auxiliary here costs, we are referring to the preamble or preliminary cost incurred before the borrowed funds is received by the organization. For example, this cost can either be involvement of a lawyer to certify the documents that you are presenting, or it can also be the processing fee. Any support that you get for you to now acquire the loan is what you call auxiliary. So, auxiliary. Auxiliary, these are costs that are incurred before you receive the loan. So it can either mean certification of your documents or a processing fee in that particular organization. The fourth one is what you call finance charge. Finance charge from finance lease. So remember I actually discussed about finance lease under IAS what? IAS 17. So under IAS 17, we discussed about the treatment of finance lease. So this is an expense. So if there is any asset you have acquired or you have for the purpose of running or producing goods and supplying of goods, and you are repaying the rental payment, we call it a lease. So therefore, any payment you are paying because of that particular use of the asset will fall under borrowing what? Cost. And the last one, which is number 5, for that matter, is exchange difference. Number 5 is exchange difference in relation to foreign exchange borrowings. So sometimes you might find that in your own country, you are not able to secure the amount of money that you want. But this amount of money that you want is available in other countries. So you are also allowed by the law to go and borrow from that particular country. So that particular country will now give you that money in the form of what? Foreign. For that matter, if there is any exchange from the beginning of the period in which you are borrowing funds, and the exchange rate prevailing at the end of the period, that exchange cost that you get there is what you call what? Exchange difference. So these are the 5 costs that relate to the borrowing what? Costs. So therefore they should be treated like that. Now, before we go further, let's now see, yes, if that is the case, which are the examples of qualifying assets? Qualifying assets. We have some of the examples given by IAS 23 on the borrowing cost. Examples of a qualifying asset. These are assets that take substantial period of time for them to be ready. One is inventory. Inventories fall under that. Number 2, we can say investment property. Investment property. So remember, I covered investment property under IAS what? 40. Then we have also generating a plant. We have also what we call power generating asset or machine. Now, these are some of the qualifying assets that have been listed under IAS 23. So an examiner will ask you to highlight some of the qualifying assets as per the IAS 23. Now, on this matter, we can also say, yes, if that is the case, we want to know now how do we determine the borrowing cost. First and foremost, we have said borrowing cost here should be capitalized. So let me discuss that. Capitalization. Capitalization of borrowing cost. What is capitalization? Capitalization, this is where the borrowing cost is treated as part of the cost of the asset. So for us to calculate the capitalization, we need to say now expenditure. That is now the purchase price, the construction cost or the purchase price. Expenditure, you add it there. Then you add now the borrowing cost there. Then for you to arrive at the correct figure for that matter. So therefore, capitalization of borrowing cost, this means that the borrowing costs are added to the cost of the asset for you to get the correct carrying amount of the asset in the books of accounts. So therefore, this how should be calculated. You take the expenditure or the cost of that particular asset plus the borrowing cost. But we have to understand on 2 areas. Number 1, we have what we call specific borrowings. Number 1, specific borrowings. Now, when we talk about specific borrowings, it means that this is a borrowed funds for a specific asset. And which asset is that? Qualifying asset. So the amount that is borrowed for specific qualifying asset is what we call specific borrowings. Now, for us in the specific borrowings, for that matter, borrowing cost is calculated by cost or expenditure. Cost or expenditure, you add there, correct? Then you take now the interest, or sorry, let's just say borrowing cost, you add, then you less any investment income. So the amount you get is what you call what? The total cost. I want to explain the meaning of the word borrowing income. So we are saying when you are talking about specific borrowings, that means you are borrowing funds for specific qualifying asset. You need to take the cost or expenditure, then you add borrowing cost, you less any investment income. How is this investment income coming in? Pay attention to this class. When you talk about investment income, you are referring to a scenario where you have borrowed money of 10,000, correct? This 10,000 is to complete that particular asset, qualifying asset, which will take how many years? Maybe 5 years for that matter. You can see. Now, because this 10,000 will be used to complete that particular qualifying asset for a period of 5 years, it means that this 10,000 here is not need, the whole of it is not needed in the first year, second year, third year, or fourth year. No, we have a specific amount of money that is supposed to be there for the first year. Then the remaining amount of money might be lying idle in your account. As a business person, you should think beyond that amount of money that you have been given in the form of a loan. So therefore, if you need only 1,000 or 2,000 or 3,000 for the first year, the 7,000 should be lying idle in the account. Instead of that amount of 7,000 lying idle in your account, you need to invest it somewhere else to generate what? An income. That amount of money generated from the borrowed amount of money is what we call investment income. For instance, in the first year, I need only 3,000, correct? The remaining 7,000 need to be invested somewhere to generate an income, for example, at the rate of 10% per year. So which means by the end of the first year, you'll be having some amount of money, which is now 700. This 700 is like an income to you. And therefore, it means that when you are repaying your borrowing cost to the organization, to the financial institution, you have to subtract this 700 because this is an income. And therefore, I'm saying now, you take the cost or expenditure, you add the borrowing cost, which in this case, maybe the borrowing cost paid with the rate, maybe 10%. What is 10% of this? 1,000. Out of the 1,000, you are investing it, you are investing at the rate of what? 10%. And maybe you are investing at the beginning or at the end. So if it is at the beginning, it will be like this. But if it is during the period, it will be a portion of the year. For example, if you invested it in June, so it means it will be 6 months in operation. So therefore, this amount of money should be multiplied by 6 months, 6 over 12. So that is how you are supposed to arrive at that. Let's see an example. Let's see an example from our notes. The example we are going to see is when there is specific borrowing costs. Specific borrowing costs. Specific borrowing costs. Let's see from our example, from our notes that I shared earlier. There is an example there which says, on 1st January 20x6, Straightman's company borrowed 1.5 million to finance the production of 2 assets, both of which were expected to take a year to build. Work started during 2020x6. The loan facility was drawn down and incurred on 1st January 20x6 and was utilized as follows. With the remaining funds invested temporarily. That invested temporarily is telling you that one will result to investment what? Income. Now we have the assets here. Let me just demonstrate. We have asset A. We have the asset A and B. So they are saying here, 1st of January 20x6. We have here it is in thousands, like that. So we have 250 here. We have 500,000 there. Then 1st of July 20x6, we need 250. Then we also need here 500. And then that is a question. That is now how the product is. Then they are saying loan rate. Loan rate is 9%. And investment rate is 7%. That is the question. Now, we have been told that Straightman Company borrowed 1.5 million to undertake the 2 projects, that is project A and B, or asset A and B. these two assets are a qualifying asset. So therefore, for asset A, the total expenditure for asset A will be 500. Correct? Then the total expenditure for asset B will be 1,000. Correct? Now we have been told that when they borrowed this money, 1.5 million, at the beginning of the year, 1st of January 20x6, it was at the rate of 9%. But they invested in a surplus at the rate of 7%. Look at what they are saying here. 1st of January, they needed only 200 at the beginning of the year. Correct? For project A. And 500 for project B. And project A, we need 500 for the whole year. And project B, we need what? 1,000 for the whole year. What happens? That in 1st of July 20x6, they added now 200 so that you get 500, then 1,500. The question now here is that for the first 6 months, you needed only 250 for project A and 500 for project B. Then from 1st of January, you don't need anything until 1st of July. That is the time you need money again so that you now proceed from there. Therefore, it means that this amount 250 from 1st of January to July is lying in the account idle. Also 500 is lying idle in your account. So therefore, this amount of money need to be invested. Correct? So the question is saying, it required, ignoring compound interest, calculate the borrowing costs, which may be capitalized for each of the assets, capitalized, which should be added on the qualifying asset, and consequently, the cost of each asset. So they want us to calculate the borrowing cost and the cost of the entire asset now, as at 31st of December 20x6. So we do now the calculation. We now say, okay, borrowing costs for the two projects. We have project A, or asset A, and asset B. Correct? Borrowing cost, they borrowed how much? 500 for project A and 1,000 for project B. So your work will be very simple. You can now say interest from where? Interest as at 31st December 20x6. By the end of that year, how much is the interest? So for that matter, it will be, this one they borrowed how much? 500. So it will be 500 for project A and 1,000 for project B. Then you multiply, what is the rate? 9%. So how much is that? When you do your calculation very well, you'll find here is giving you 45,000. When you remove now the thousands, then you have here 90,000 for project B, or for asset B. Now, out of these, that is borrowing cost as at the beginning to the end of 31st of December at the rate of this. But now, this money, the whole of it here, this is the interest, yes, by the end of the year. But we did not use the whole of money. We invested some of it at the rate of 7%. How much did we invest? We invested 250 from project B, and we also invested 500 from project B. So for that matter, you can now say interest income or investment income. Investment income. Investment income now will be for what amount? 250 and 500. So you take now 250 and 500 for project B. You multiply by 7%. But for how many months? Now it ran this we have from 1st of January to 30th of June 20x6 is when we invested that. So it means it will be for 6/12. So how much is that? For that matter, here you'll get 8750. We are subtracting, and also you get 17,500 is subtract. So that we get now the correct borrowing cost, being in this matter as 36,250, and this one is giving you 72,500. So this is the borrowing cost. What was the question saying? Ignoring compound interest, calculate the borrowing cost which may be capitalized for each of the project, each of the asset. Very important. Then it continues by saying, and consequently, the cost of each asset as at the 31st of December 20x6. So cost of asset. Cost of assets. Correct? Then we have now asset A and asset B. What is the cost? Well, we are now to calculate this cost. Now we can say expenditure. How much is needed for each? We need here 500,000. We need here 1,000 or 1 million, sorry. Then we now say add borrowing cost, because you have been told borrowing costs need to be capitalized. So you add the borrowing cost here, which is 36,250, and here 72,500. So if you add, you get now what we call the cost. In this case, it is 536,250. This one is 1,072,500. So that is how to calculate borrowing cost when you borrowed money for specific qualifying asset. So we go to a scenario where you are borrowing money but not for specific. It's either for other assets, but out of these other assets, you are now told, now this asset, there is one asset that is qualifying asset, and we have other assets that you can construct. How do we go about for that matter? Correct. So pay attention to my explanation before I go to that. Now, if you are borrowing money for general purposes, we call them general borrowings. General borrowings. Now, if you are borrowing money for general purposes, that is for general assets, you are borrowing money for general assets. General assets. For that matter, you have to determine the correct rate of borrowing cost. So in this case, you have to determine the correct rate of borrowing cost. That is specifically interest. Why? It means that some amount of money that you have borrowed will go to the qualifying asset. Some will go to other assets that you are constructing. For that matter, it means other assets will not be part of the IAS 23. Therefore, you have to be very specific. From the question given, you have to know, is it general or specific? For that matter, if it is general, we need to calculate the rate, what we call capitalization rate. Capitalization rate is the weighted average of borrowing cost. Of what? Borrowed funds outstanding, borrowed funds outstanding at the end, comma, excluding, very important term, excluding borrowings for specific qualifying asset. I want us to understand the question right. Now, when it comes to the borrowing for general purposes, it means you are borrowing for general assets also. You are not specific on how much for qualifying asset. So how do we determine the rate that we can use to determine the borrowing cost as interest? For us to determine the interest rate there, we need to calculate what we call capitalization rate. What is capitalization rate? Capitalization rate is the weighted average of borrowing cost of the borrowed funds, excluding borrowings for specific qualifying asset. That means that we shall have several sources or several debt instruments that have been applied by the entity, correct? Then these debt instruments have different rates of interest. Then we have also, out of this debt instrument, we have one debt that is specific for borrowing cost. So for us to determine the rate, because there are different rates now for that matter, you need to get one rate that will be used to determine the borrowing cost as interest. So therefore, we need to calculate what they call borrowing capitalization rate. And for us to calculate capitalization rate, we now say we need to calculate the weighted average. Weighted average in this case, it means that It is not the whole of the rate that is given there, but will be based on the proportion of that particular debt out of the total debts that we have. For example, let me just give an example. You have general borrowings from maybe bank, I want to give two examples, from one bank and from different banks. For example, we have money that we have borrowed from different banks. We have KCB here. KCB has given loan at the rate of 10% loan, KCB, correct? KCB. Then Equity has given us a loan at the rate of 12% loan, Equity Bank, correct? We have also acquired another loan at the rate of 15%. This is ABSA. Loan, ABSA. So you can see that we have now different debt instruments here, correct? These different debt, maybe from here we got 10,000, here we got 15,000, and here we got 20,000, correct? You can see. So these debts here, these debts we have here is what we call what? General debts. We don't know which one belongs to specific or qualifying asset. Assuming now, the statement says that, maybe let me continue with the same. Let me say 17% for loan from which bank? Maybe say Rafiki Bank. Let's say Rafiki Bank. Maybe we got 25,000. Then the question is, then we say now, this Rafiki Bank here, this 17% loan from this Rafiki Bank is purely for qualifying asset. So, therefore, if you want now to determine the rate that will be used to determine the borrowing cost, you have been told you need to get the weighted average. Weighted average here means you add all this, then you now say this over the total, this over the total, this over the total, and this over the total. That is what you call weights, proportions. So you add all the debts, then you now get the proportion. Now, weighted average in this case, because we have been told for us to determine the rate now here, it will be the weighted average. Our work will be very simple. We have been told capitalization rate is the weighted average of borrowing cost of borrowed funds outstanding at the end of that, means at the end of the period, excluding borrowing, so which means we will not use this if you have been told it is a qualifying asset. So we will use this one. So therefore, our work will be very simple. Now we can now say, okay, the rate here is 10%, okay, times 10,000 over the total. How much is the total? This plus this, 25 plus that, 45,000. So 45,000, you can see that. Then you say plus 12% times 15,000, divide by the total, 45,000. Then you say plus 15,000, 15% of 20,000, you divide by the total of how much? 45,000. Correct? Now, once you work out this one, maybe you will find the answer to be maybe 12.8%. This 12.8% is what is called interest rate to be used on the qualifying asset. So what is the borrowed funds for the qualifying asset? 25,000. What is the borrowed fund for qualifying asset? 25%. Then therefore, what is that borrowing cost? It will be 12.8%, which is the weighted average, times the borrowed funds for the qualifying asset as a 25%. Then you get the answer. Now, this is when you are borrowing from different banks. What if you are borrowing from the same bank, but the bank is giving you the loans, with the varying rates? For example, we have a loan of 10% loan. Another one is 12% loan from the same bank. We have also another one 15% loan, and then we have 17% loan from the same bank. Then you are told this 17% loan is for qualifying asset. So your weighted average rate will be for the first one, second, and third. The same procedure repeats. So let's see an example, class. Let's see an example on the borrowing costs. Let's see an example. Example is there in our notes, so you can see example there. It says, example is given there. It says, a Crony company had the following loans in place at the beginning and the end of 20x6. At the beginning of 20x6 and at the end of 20x6. So in this case, we are saying the borrowing funds should be at the end of the period. So therefore, our interest rate should be of the end balance, outstanding balance, but not outstanding balance at the beginning, but outstanding balance at the end. Very important point. So we have this information here. So we have been told this is 31st December 20x6. Then we have 1st January. So this one is 20x6, correct? So it is in millions here, in millions there, like that. So we have 120. Well, this 120 is at the rate of 10% bank loan, repayable 20x8. We have also 9.5% bank loan, repayable 20x9. Then we have 8.9% debenture, repayable 20x7. So we have 80,000, then we have here dash, then we have here 120, we have 80, then we have 80 here, we have 150. The question is saying the 8.9% debenture was issued to fund the construction of a qualifying asset. So therefore, this one here is a qualifying asset. That is what we have been told. So this amount here is a qualifying asset. And when we are now determining the rate of interest, we will not use the interest rate for the third loan, but we shall use the interest rate for the first loan, second loan, excluding the interest rate for the third loan. Why? The third loan is a rate for a qualifying asset. So therefore, for us to calculate the capitalization rate, we need to get the weighted average of 10% and 9.5%. Correct. Then question. Question. Following and a piece of machinery. Debenture was issued to fund the construction of a qualifying asset, a piece of mining equipment, construction of which began on 1st of July 20x6. That construction of a qualifying asset begins on 1st of July. On 1st January 20x6, a Crony company began construction of a qualifying asset. Correct? Qualifying asset, which is now costing how much? 150,000. A piece of machinery for a hydroelectric plant. So what is the name of that qualifying asset? Hydroelectric plant, using existing borrowings. Expenditure drawn down for the construction was 30 million on 1st of January and 20 million on 1st of October 20x6. Required, calculate the borrowing cost that can be capitalized for the hydroelectric plant machine. Solution. First and foremost, I've explained that saying 8.9% debenture is a qualifying asset. Therefore, we will not use this one when determining our capitalization rate. But now it says that why? Because that was purely for that. Then on 1st of January 20x6, a Crony company began construction of a qualifying asset, a piece of machinery for a hydroelectric plant, using existing borrowing funds, so we don't know which one, but we have been told 8.9% is a qualifying asset, correct? Expenditure drawn down for the construction was 30% for 30 million 1st of January 20x6. So they withdrew money, 30 million, to be used from 1st of January 20x6. Then they will draw again 20 million to be used when 1st of October. So therefore, if you want now to calculate the borrowing cost, should be for this period. Which year is that? 20x6. So from January to September, there was amount that we are investing somewhere there, but we have not been told anything to do with the investment in this matter. But we've just been told calculate the borrowing cost and capitalize them to be capitalized. So our work will be very simple. Calculate the weighted average rate. So the weighted average rate at the end of the period, not this one. At the end of the period is this. And therefore we are saying we are not going to use this, but we will use this one. So our weighted average will be 10% of 120 divided by the total ngapi? 200. Then you say plus 9.5% of 8 divided by 200. Then what is your rate? If you calculate very well using your answer, your calculator, you will get 9.8%. So this is our rate. This rate now is what we are going to use to calculate our borrowing cost on the qualifying asset. So therefore, borrowing cost now will be 9.8%. But now they are of different rates, different years. So we have the first one and the second one for that matter. So we can now say, okay, borrowing cost, or just borrowing cost will be now, we go back to the question. They are saying expenditure drawn down for the construction was 30 million on 1st of January and 20 million from October. So therefore 30 million was drawn 1st of January. So it ran for the whole year. So therefore it will be 9.8% of 30 million. Correct? Then we introduced more 1st of October. So for that matter, 1st of October to December, how many months are those? 3 months. So therefore it will be 9.8 times 20 million, but for 3 months. So this 20 million was introduced for 3 months, but this one, 30 million, will run from January to December. How much is the total borrowing cost, class? The total borrowing cost now there will be 3.43 million. Now, if you want now to calculate the cost of asset, the cost of qualifying asset, how much is the cost of qualifying asset? It will be 20 million plus 30 million. You get 50 million plus the borrowing cost. So the qualifying here will be 30 million plus 20 million plus 3.43 million. You get the cost of what? Borrowing cost. I hope you are enjoying this lesson. Now, another question is now, yes, when do we begin to capitalize? So, commencement of capitalization. When do we start to commence? For us to start capitalizing the borrowing cost, you have to meet 3 main conditions. Condition number one is that for you to treat this borrowing cost as capitalized here, for that matter, you have to ensure that one, incurred expenditure. One is that expenditure on qualifying asset is being incurred. So you have to prove that it is true you are incurring what? As expenditure on a qualifying asset. Number 2, you have also to prove that the borrowing cost is being incurred. Correct? Then number 3, you have also to prove that activities are in progress. Activities are in progress relating to qualifying asset. So if you prove that activities are in progress, and you have also to prove that the borrowing cost you are incurring as an entity, and you are also incurring the expenditure on the qualifying asset, that is the time you can begin now to capitalize the asset. Now, we have what we call also suspension of capitalization. So this capitalization can also be suspended capitalization. This capitalization can also be suspended when, now, not all the time projects face favorable time for construction. For example, any occurrence, any natural occurrence or a calamity may come and affect the progress or delivery of that particular asset. For instance, in 2020, we experienced a COVID-19. COVID-19 actually interrupted all the activities in any country, whereby businesses were suspended, no construction were going on. So what happens there is that, for that matter, the project has been suspended. If the project has been suspended, how do you treat the borrowing cost then? For that matter, the borrowing cost shall also be suspended. Should also be suspended over the period. Yes. Then what are you doing if that is the case? If you are suspending, then it means that you are treating borrowing cost as what? Expenses, which means take it to the P and L. Sorry, as expenses. So you also need to suspend the borrowing cost over that period of time. However, you treat the borrowing cost as ordinary expenses in your P and L account. Correct? Now, what if there is now cessation? Cessation of capitalization. When do we stop capitalizing the asset? We have suspension here and we have cessation here. We can only stop capitalizing the borrowing cost if the substantial activities have been notified about the qualifying asset. So in this case, you can only do this one if there is complete qualifying asset, which means the qualifying asset is actually complete, only minor activities are remaining. So we can only do cessation of the capitalization if the qualifying asset is complete and maybe minor modification is remaining. And therefore, we have also proved that we have substantial activities have been done. So if you have done substantial activities on that qualifying asset, then it means you can cease from capitalizing. And when you talk about this statement, it means you are treating the borrowing costs as what? Expenses. Not that thing class. If you say cessation of capitalization, it means that you are not adding the borrowing cost on the qualifying asset, but you are treating it as normal ordinary expenses. Then suspension also, you are not treating it as a capital asset, but you are taking it as an ordinary what? Expense. So that is now the end of International Accounting Standard 23, borrowing costs. Thank you so much, and I love you, class. May you kindly subscribe to my YouTube, that is CPM Akan SIPS College. CPM Akan SIPS College, and you'll be able to see so many videos concerning the financial statements and the financial reporting. So I've been analyzing this particular topic, and I say thank you so much for giving me an opportunity to deliver on the IAS 23. Bye.